Hey there, and welcome to today's Daily Premium Newsletter for March 27th. So the Chicago Board of Exchange has asked the Securities and Exchange Commission, or the SEC, to reconsider its hardline approach towards Bitcoin ETFs and other cryptocurrency-based exchange-traded products, or ETPs. The CBOE President Chris Concannon's letter was written in response to a letter issued by the SEC in January 2018, in which, among other concerns, the SEC expressed unease over satisfactory liquidity in cryptocurrency markets, as well as manipulation risks. From the CBOE letter, while cryptocurrency-related holdings do raise a number of unique issues, the CBOE firmly believes that such holdings do not require significant revision to the well-established frameworks or evaluation related to valuation, liquidity, custody, arbitrage, and manipulation. Rather, each cryptocurrency fund and underlying cryptocurrency-related holdings should be evaluated on a case-by-case basis in a manner very similar to previous funds and their underlying holdings. Concannon added in his letter that the CBOE believes that the arbitrage mechanism would function identically to commodity-related ETPs, thereby keeping the price of the ETP in line with the price of Bitcoin and limiting the risk of manipulation shares of the ETP. He continued, "The nascent futures markets are quickly developing, and while the current Bitcoin futures trading volumes on the CBOE Futures Exchange and CME may not currently be sufficient to support ETPs seeking 100% long or short exposure to Bitcoin, CBOE expects these volumes to continue to grow and in the near future reach levels comparable to those other commodity futures products at a time they were included in the ETPs." This letter comes as the SEC has been stepping up measures against companies engaging in crypto-related activity this year. On March 15th, the SEC confirmed dozens of probes into cryptocurrency companies. Earlier this week, a source speaking to the Wall Street Journal said the SEC would increase its scrutiny in launching examinations in the top 100 hedge funds. If the markets can make progress on the reasons against allowing ETFs or ETPs, the average trader should be much happier. That being said, it looks as though the SEC is going to keep rejecting this until the trade data and policing of the sector, both internal or external, are mature enough that they can't be manipulated like toys in a bath. And so with that, I'll turn it over to Doc. Have a great day.
Hey guys, it's Doc for ReadySetCrypto. Tonight I'm going to continue my little series of going through different studies just to show you some different tools that you can use within the markets. Tonight, what I'd like to do is to show you a couple of what I call trend indicators. Now, even though at first blush these two may look the same, they're really not. They're quite different from each other. However, they can be used for kind of the same thing. So the idea here is, first of all, I'll start with a choppiness index. And the choppiness index, what it's going to do is it's going to look for linear trends. Now, linear trend is something where the price goes in one direction without interruption. And what that's going to do is lead a chart into what's called exhaustion. So we have these levels up here. So above 61.8 is generally, this is supercharged. This is where we have a chart which is doing nothing but going sideways. And sideways movement tends to restore energy. So think about this. If you were going to run up the side of a mountain, could you just get up the side of Mount McKinley and could you summit that thing just by running up there as fast as you could in the course of a day? So here we are, Mount McKinley or Denali, whatever you want to call it, it's 20,000 feet, right? So that's only 4 miles. You should be able to run straight up that. Well, I don't think you're going to make it. What's going to happen is you're going to go as far as you can, and then you're going to collapse in a heap, and you're going to rest for as long as you need to. And then you'll say, okay, I'm ready to go again. And then you'll move again until you collapse in a heap and have to rest. And then the pattern will continue as long as it takes. Rest, run, rest, run, until you can actually summit. And so this is how markets move as well too. Rare is the time when we see them just take off like this. This is actually a fairly rare move which requires a lot of volume. Most of the time they will go in much more start-stop fashion where they go range expansion. So let's pull this back here. Range expansion to range contraction. And so this is a good example of using the choppiness index here, because that range expansion, that very linear move, takes an awful lot of gas out of a market, takes an awful lot of energy. And what you'll find is that from these range expansion moves, the market has to rest and will consolidate for a period of time until it builds up enough energy to run again. And so in the trending market, this is a very, very accurate way of identifying when we would, first of all, expect to see the market rest. So if you're swinging this, maybe perhaps a good place to take profits or thin out the position, do whatever you're going to do. And then as the market restores, think about this like a spring winding up, getting tighter and tighter and tighter, adding potential energy to that until it can't take it anymore and it evacuates that particular range. So yesterday I talked about overbought, oversold, oscillators, those kind of things with stochastics, and I don't really use overbought, oversold very much. However, what I do use a lot is range expansion, range contraction, range expansion, back and forth, back and forth. That's how markets really do operate. So that's why I find the choppiness index here within TradingView. So it's within TradingView, and it's a good tool. And I usually use a period of about 14 for this. And it's one of my mainstay studies. Now, not every package has a choppiness index. In fact, what I found is that TradingView is one of the rare ones that actually does. But what is available just about across the board is the ADX, or Average Directional Index. So this is just kind of a different take on the same kind of thought. And what we're looking for here in this case is the strength of the trend. This doesn't look at linearity. This looks at the strength of the actual trend in place. And so the higher the value, the stronger the trend. So let's go back a little bit here so we can see this rally that was back here in, let's see, what is that date? So that's the summer of 2017. We can see that that was a very, very strong trend and gave us an ADX figure of about 60. Now that's a value that you don't see very often. Okay, so that's almost unsustainable. So I would expect to see from that to go from range expansion to range contraction, which is what it did for the next 2 weeks. And in fact, what happened is for the next several weeks, it went into a range like this. And this is where the converse happens, where the ADX will actually get down to a level of 20 or below when it's absolutely trendless. So here's an example of that where we have no trend here for this period of time, and that was early August of last year until we saw the breakout from there. So range contraction or a very low value of ADX. So if you see a very low value of ADX, it's probably not going to stay there for very long. Conversely, if you see a very high value of ADX, that means that that's a super strong trend, unlikely to continue going in that direction. So we can see that last year's December rally got to an ADX value of about 60. So that's about as much as we see. And then after that, what did we see? Sideways movement that brought the ADX down to almost 20. And so various times we've seen the ADX going sideways. So again, you see this, just kind of a sideways move here on Bitcoin and brings it down to a very low value. So from that very low value, it's unlikely to stay within that, so it has to trend. Now, what you'll notice about both these studies, not only the ADX but also the CHOP index, is that they don't tell you which way things are going to break. They don't forecast the break direction at all, which is fine. This is what price is there to tell us. Price is there to tell us whether or not it breaks outside of this box or to the downside of this box. So there you go. There's a couple of studies that I use for looking at trend. I've used the ADX in the past, and I did use the ADX until I discovered the CHOP index a few years back, and that is my go-to study. All right, folks, not much else to talk about here. Markets are just sort of winding down, looking for a catalyst, finding support, going through the bear market process of wringing out the excess. From the parabolic move, we have the hairy back, and this thing needs a shave, and that will occur over time. So we just have to be patient for right now. This is a good time to sharpen your saw and get your skill set up. So please join me tomorrow night at our webinar. It's going to be 8 o'clock Eastern time, and I'm going to be going over some things that I think that you need to be doing to sharpen your skills when it comes to charting. Take care, folks. We'll see you tomorrow.